Welcome to Stock Charts Trading. Hopefully our name gives it away. We're all about technical analysis. Technical analysis can be hard when you're first starting out because it's a new language for you to learn. In this video, we're going to talk about the difference between a bullish and bearish market. Also in this video, we're going to include the strategy of how to read the market as it's turning from bullish to bearish. This reversal pattern is a must-have in your trading tools. We're going to review some past history from the Dow Jones Industrial Conception and Bitcoin and what the comparison is of the two charts. Make sure you stay all the way to the end because we're going to include the best time frame to read charts, the best indicators for trading a bull or bear market, and the only two systems you ever need to know on how to get into a trade. And if you like the video, then go ahead and subscribe to our channel. I'm sure some of this information you've already heard before, but I promise you this, you're going to have a lot of aha moments in this video. To start off, let's get Google's interpretation of bullish trend. It's an upward trend where price of the overall stock rises. And the takeaway from that is when price rises, it's because investors' confidence is rising about the stock, that it's a good quality stock. Keep putting money into it. Google defines bearish trends as the market prices going down or falling. And the reason that price falls is because people are taking their money off of the table, out of that stock, selling it. The vast majority of investors go with the trend. So it's very important to identify what it is. If it's bullish, you go long. If it's bearish, you sell short. Now let's discuss some of the problems there are with identifying a bear trend versus a bull trend. The first thing I see is investors trying to use a small time frame, like 15 minutes. Here's the Dow Jones Industrial Average, 15 days, 15 minutes. We can see that there's a high, then an equal high, a lower high, equal high, lower high, lower high. At the same time on the chart, it's showing us a low, lower low, lower low, lower low, and again. If you didn't understand that, then watch our video on higher highs, higher lows. Now that I've colored them in, it's pretty easy to see this is creating a downward channel. And you would say the trend is going down. But if I change the chart from a 15-day, 15-minute to a daily chart, 1 year, 1 day, the chart looks totally different. On this chart, we're making higher highs and higher lows, giving us an uptrend. I want you to catch this visual picture so that you can understand a 1-day chart is going to read completely different, giving you an uptrend, as the 15-minute is only going to give you a small glimpse of what's happening on the 1-year chart. And that's where the problem is. People think that the 15-minute is trend, but you can see there's not much effect to this overall price movement going higher. So I want you to think of a big number, like an anniversary number. Did 20 years come to your mind? Because 20 years gives you a significant amount. There's a lot of celebration around 20 years, and a lot of things can happen in 20 years, even stock price movement. Now, of course, on 20 years, you shouldn't still use a 1-day chart. Increase it to the 1-month chart, giving you a picture that looks more like this. So the first chart, 15-day, 15-minute, would be consumed in this one candlestick. The next chart, 1 year, 1 day, would consume these candlesticks. Because it's a 1-month chart, 12. But even in these candlesticks, they don't really give you the highs and lows. Kind of like here showing the highs and here showing the lows, giving you a great place to enter into trades long term. Now, if you're a short-term day trader, it makes sense that you would use a smaller time frame, but make sure you're looking at a chart 5 times bigger than the move you anticipate. If you're only going to be in it for a day, you have to have a 5-day chart. If you're a swing trader thinking that you'll be in a trade for a month or two, then you need to use a year chart. Longer term trader? That's right, use a bigger time frame. Now, here's your next trick. Using this big time frame, I want you to identify what corner is the stock price in. That's correct, top right. With an uptrend, price should be in the top right corner. If I were to start here and move my chart back, you'd see that we're in the bottom right corner, meaning we are low in price. The other good signal is that we've seen price high before, which is a good indication that price should go back up to those old highs. Why do I say should? Well, if we look at the Dow Jones Industrial over the last 100 years, we can see it was pretty much always in an uptrend. Yes, these were huge pullbacks, but because price never broke below this lowest low, it means the trend has always been in an uptrend on a 1-year chart. Now, can I talk about another problem of identifying trend, bullish or bearish? Candlesticks. There's so many candlesticks telling you that they formulated a reversal pattern. But think about it. If you're looking at a candlestick on a 15-minute chart, it's not going to tell you what's going to happen on a 1-year chart or a 10-year chart or longer. That one candlestick is not going to deter the momentum of the trend on a bigger time frame. Now, if you use the right time frame, that candlestick will be a world of difference for you. And let me show you the difference. Right here, we have a hanging man. First thing to identify about the hanging man is you have these big long wicks. First, the green candle. You open right here in this corner. Then throughout the day, price went down really far. Then the bulls pushed price all the way up, closing higher than the open. And that's why it's green, because it opened here and closed higher. Even though throughout the day, it pushed all the way down on this wick. You can see that the high, there's typically little to no upper shadow, meaning that at the end of the day, it rallied the best, again, into the close. Now, the difference of the red one is the open was higher versus this open. Price sold off, but came back up in the close, but never going higher than the open. So it'd read like this: open here, close lower, giving you the red candlestick. You got it? So now that you know what a hanging man looks like, let's look at a 15-minute chart. We've already identified that the momentum is down, and so this is a perfect scenario. I highlighted all of the tops blue, so that way we can look at them a little closer. We'll start with the first one in the top left corner, and this could be determined as a hanging man. Price moved up into the hanging man and then sold off afterwards. Here we have another one giving us a hanging man, and price sold off. 2 for 2. Your eyes would have to be pretty good. We have 2 smaller ones here and selling off. 3 for 3 after a big cluster of candlesticks. Maybe you pick this one out of the bunch and get a big sell-off. Here you get an inverse hanging man, and maybe you pick this one out, which maybe would have caused you a loss unless you held it for enough time. And looking at these 4 here, I don't see a hanging man in any of those clusters before selling off. So what's my point? Well, out of 12 trades, there was only 6 that actually had hanging mans. So if that was your one indication of getting into a trade, you would have missed a lot of opportunity. But now here's the bigger takeaway. Did those little 15-minute candlesticks affect the overall trend? Well, not on the 1 year, 1 day. We are still making higher lows until we break the highest low. We're still in an uptrend. Now let's take a bird's eye view of the Dow Jones Industrial looking at the 10-year 1 quarter. We see we have an uptrend in the top right-hand corner, a black candle meaning sell off, a lot of wicks without the body. And if you notice what happened last time, there was a lot of wicks, was an indication of sell-offs. But right now we're looking at an inverse hanging man. And this could be a reversal setup from a bull trend to a bearish trend. So now let's go to a higher time frame and see if it tells us anything. Looking at a 20-year, 1 year chart, do you see it? That's a hanging man right there. Why did price go higher? That's a great question, and you always need to anticipate that even though you get a candlestick or you get a reversal pattern, that there's a possibility that price still goes even higher. But that's why I don't like to use a candlestick alone to tell me a reversal pattern from a bullish trend to a bearish trend or a bearish trend to a bullish trend. And here's why. For an uptrend to occur, we have to have higher highs and higher lows. We have a high here, and then we have a higher high. We have a low here, then we have a higher low. Higher high, higher low, and this is where it gets interesting because this low, when it makes an equal low, does not mean reversal. It's equal, it just means horizontal support. Even these equal highs doesn't mean reversal pattern. And that's another takeaway I want you to think about. Was there a hanging man at each one of these resistance levels? And even if there was, it didn't mean that it changed the trend. What changes the trend? Well, if an uptrend stays an uptrend as long as higher highs and higher lows are made, and a downtrend is made when lower highs and lower lows are made, then there's only one thing to identify. That is the break of a higher low support level. Price has to go below that low, then typically it will retest before going lower. And why will it go lower than that? Because we know for a downtrend to happen, it makes lower highs. Here's a high, here's a lower high, and lower lows. Here's a low, another low, and a lower low. So the rule is in an uptrend, once you break a low, you are in a bear trend. Identifying all the pink lines as support of the lows. This one goes horizontal, head and shoulders horizontal. The wedge formation goes diagonally, along with the broadening pattern, and then the triple top comes back horizontal. Once it breaks the pink line, the red arrow indicates that it's now in a bearish trend. So I'm going to do it to you one more time. If we had a hanging man candlestick here, it did not indicate a bullish to bearish trend reversal. Nor here, nor any of these 3 highs. Even if a hanging man came here 4 different times, it didn't indicate a reversal, nor on these highs. The only thing that indicated a reversal is once price broke below these lows. And the reverse is true for downtrend. Once you understand that, it should revolutionize your trading. Price will remain in a downward trend until the resistance is broken and price moves above. And that's why it also matters on time frame. You can look at a 15-minute chart, and for that 15-minute chart, its time frame has bullish and bearish head and shoulders patterns, double tops, double bottoms, to identify if you should get into a bullish or bearish trade. If you focus on these patterns more than you do on candlesticks, you'll have a higher probability of success. Some new traders ask, should I trade bullish or bearish? And it should always be indicated by the charts. Yes, over the history of Dow Jones and now the cryptocurrencies, you could say that you should always be bullish. And here's a chart of the Dow Jones 1905 to 1980. pretty much went sideways. Then the roaring 20s. Then we had the Great Depression, which price went pretty much exactly down to the bottom. And then it kept roaring upwards. Some things I want you to notice from the beginning of time to this biggest peak, which was a huge run up, almost 500%. If you haven't already, watch our range box video, because from here, price moved up 3 range boxes. Why is that important? I'm going to show you more tricks. If we look at Bitcoin from the conception over to its biggest peak in 2018, which was about $20,000, after its huge roar from basically nothing, it went almost completely flat, just like the Dow Jones Industrial. Then after that, it shot back up. Where did it go to? Well, remember the Dow Jones, we took from those highs and duplicated it up, and we got 3 range boxes out of it. 20,000, 40,000, 60,000. Well, let's look at what happened to the Dow Jones. After we hit our 3rd range box, price really consolidated for a couple years back and forth, which is around right here. That's right. Look what happened over the next 40 years to the Dow Jones Industrial. It moved over 4,000 points higher. Based on these results, we could take away that cryptocurrency is a good investment for long term, especially the next 40 years. If you were to ask me why the crypto market is doing so much better than the Dow Jones did, I would have to say liquidity issues. Right now, we have so many more hedge funds flushed with cash putting their money into cryptocurrency, and that's why we have the bigger run up faster than we did with the Dow Jones. Think about all the things our country went through and the finances. We had things happen in year 33 with gold, the dollar, different standards, and cryptocurrency. We're not seeing that problem because we have the fiat money already in place. Now for the good stuff. Based on all of this information, what strategy is best for you to trade with when considering the market trend? For me, I like to buy low, sell high, or I like to sell high and buy back low. Quick look at this picture, we'd have to say that the Dow Jones identifies more with price being at all-time highs. Remember the top right side of the screen instead of the right buy low, sell high. So a pump and dump strategy would work better here. When price is really high, sell off the highs, making the profit as price goes lower. Sell the News course is just that. It gives you a detailed system on how to understand the highs and where the reversal patterns will happen and what to do to make the most amount of money. There's only 2 trading systems you ever need. Once you have those, you master the market. This is one of the 2 trading systems you need to have in your trading toolbox. What's the other one, you ask? Bear Trend Trader. Sell the News gives you the pivot point to enter into the trade lower from all-time highs. Bear Trend Trader gives you the trend continuation point to get in as price continues to sell off. The trend is your friend until the end, even in a bear market. If you're a little bit lazy like me, the Polynomial Channel Indicator is perfect for you. And here's why, because it prints right on your chart. It shows you the trend is up. It shows you all the perfect places to enter into the trades and where to exit. It even shows you where to be patient and let price come down a little bit further before getting into the trade so that you're buying at the perfect place in anticipation of it continuing higher. Gives you a great mid-range target if you don't want to wait all the way till the upper band. Even shows you downtrends, where to enter into the trade lower, where to take your profits. I don't typically take counter trend trades, but if you did, you might want to use the midpoint to take off your profits. Quick question, should we enter into the trade long here? Remember our rule, it has to break the lowest high. And with the polynomial, it helps you resist the temptation of getting into these trades at the wrong place. Looking at the chart now, you're probably thinking wait for price to come back down to support before getting in, or shorting here. Downtrending, short the stock. Uptrending, get in long, take your profits at the midpoint, or let your runners run to the high side and get in again, get out at the midpoint, or let your runners run. The great thing about this is it also has a built-in stop loss. Using this bottom support channel as price moves higher, move your stop loss higher. So if you had this indicator right now and you saw that price was up against this resistance, what would you do? Well, as soon as I stop this video, I'm going to enter into this trade lower. Take my first target at this midline and maybe even catch this lower horizontal line. Uptrending, take profits, or enter counter trend trades, take your target at the midpoint, go long at support, take your profits at the midpoint, or let your runners run to the high side resistance. Enter into the trade 1, 2, 3, 4, take your profits 1, 2, 3, and if you're using a trail and stop loss, even if you got in right here at support and you got out right here, it's still a 6% move on your money. Enter into the trade at the lows, take profits at the highs, enter into the trade at the lows, take profit at the highs. I'm actually in this trade because it came up against this resistance. My target was this lower band. To my surprise, price went up 23% today. So this morning I added another position and I'm already making a profit. As you can see, this inverse hanging man. I'm going to hold on to it until it comes all the way back down to my original target, support. Do I look stressed out to you? I'm doing a video while trading, even though price went 22% against me. Why? Because I have the structure of the polynomial channel indicator. It makes things so much easier. Remember when I was talking about sell the news up against resistance? The polynomial indicator does that for me over and over every day. And for sell the news, the polynomial gives me these entry points at the highest high before we change from a bull trend to a bearish trend. Remember our rules, follow up the lowest low. Once price breaks below that low, we're now in a bearish trend. So when I'm in a bearish trend up against resistance, what does that say? That's the second course, bear trend trader. The trend is your friend until the end, even on a bear trend. And that's what gives me confidence to take these trades lower. Buy the dip and let your runners run because it never comes up to the high side of the resistance. Buy the dip, now take off your profits. Until we break the lowest low, we're still in an uptrend. And that's why I would consider buying the dip here. Well, not till price comes back down to the bottom. See how easy it is to analyze good trades, bad trades, where to get in, how long to be in the trade. If price never comes down to support, then there's no need to get into the trade. If price doesn't come up to resistance, no need to exit the trade. With this, it will really make you a patient trader getting into the perfect places. I'm going to have to short this one lower also. If you're wanting big moves, this is the indicator for you. Right here, up against resistance, short the trade. That was a 50% move. Where to? Right down to polynomial support. Get into the trade. From support to resistance, it's 100% profit in 50 days. Up against resistance, what do? Take your profit or enter into the trade lower and price drops down another 40%. Understanding technical analysis and having the indicators prove to you when to get into the trade is the difference of making money or losing money in the market. Another thing I like to do to tweak my system just a little bit more that matches the bear trend trader is to include W pattern indicator. It's great because it gives me the confluence of Fibonacci trading and the mindset behind it up against the polynomial resistance before getting into the trade. I like to use the indicators together, even though this trade's working out perfectly. It wasn't against the polynomial resistance. Not that this is a bad trade up against polynomial resistance, but it doesn't have a W pattern. Remember before we were looking at this down channel, but we weren't going to buy it right there and going long because price was up against the polynomial channel. Now with the polynomial and the W pattern, it gives me a better confirmation. This is a great place to short the trade. W pattern up into the polynomial resistance, great place to enter into a trade. The polynomial buy the dip into resistance, take your profits, is a great trade by itself. And yes, from this resistance level, it came almost all the way down to support. And it's probably going to do the same thing here. But with all the charts that we're looking at showing you all the amazing setups, wouldn't you like to filter through just the best ones? Sometimes I have a hard time spreading my money out over all the possibilities of trades, so it's nice to have another reason why not to get into a trade. With Sell the News course and Bear Trend Trader, they will give you everything you need to understand the market and how to trade it. With the polynomial channel indicator and the W pattern, it will give you phenomenal trade setups. If you're really worried about the market crashing like I am, then these are the tools you're going to need to successfully trade it lower. Take it from me, I short the market every day. I understand a thing or two about shorting the market. Since you've waited all the way to the end, I'd like to give you a special offer. I'd just like to close out this video by saying thank you.